So I'll pass it over to Abby, who is going to dive into, some of the basics. Abby, take it away.
Yeah, thank you, Patrick. Yeah, I'd like to welcome everyone to the webinar. So, talking about cash conversion cycle. So, whenever we talk about cash conversion cycle, so this is a metric that is computed in days. So, basically, when someone says my cash conversion cycle is 10 days, 20 days, 30 days, 90 days, so what does it actually mean? So, So cash conversion cycle is the number of days that a business has to finance its operations. Uh, so in the next slide, we will get into more details on this. But let's first look at the mathematical formula of cash conversion cycle. So cash conversion cycle is equals to days inventory outstanding plus days sales outstanding uh, subtracted by days payable outstanding. So, so this is more of cash conversion cycle looks into three aspects. First one is inventory. Second one is your accounts receivable. And third one is days payable outstanding. So in terms of days inventory outstanding, what does it actually mean is how many days does the inventory stay in the warehouse before it is sold? So that is the average number of days uh, inventory sits in the warehouse. So how much inventory are you holding? So is it for 30 days, 60 days? So depending on industry, it can vary. So if it is a fast moving product, so your inventory days may be lower. And if it is a slow moving product, wherein you have to do some work, uh, if there's a manufacturing process, the inventory days may be higher in those kind of companies. And moving to days sales outstanding. Uh, so this is the accounts receivable balance that you see in the balance sheet. So how many days of sale have I not collected? Days sales outstanding means that. So again, as per industry, this may vary. Some industries, the DSO may be lower, but in some, uh, let's say, a roofing company or a construction company, the AR balance may be higher, and it may take longer time to collect. And days payable outstanding refers to the payables. So how many days of purchases have I not paid for? So overall, again, it does depend on the credit period that your supplier gives to you as well. So whenever you're computing these metrics, what you should be looking at is uh, if the seller is telling you, generally my suppliers give me 30 days of credit period, but however, when you compute the days payable outstanding, you see that the days payable outstanding is 60 days. So what that would mean is they are stretching payables, which may impact vendor relations in the future. So so these kind of things should be looked into when you are computing cash conversion cycle. Let's move to the next slide.
Yeah, and one last thing on the cash conversion, just to circle back for those, actively buying businesses. Abby touched on one point, and it's important. So if you're looking at construction businesses, roofing companies, insurance related work, your cash conversion cycle, understanding it's very important. And the reason why is there's a long-tailed uh, days sale outstanding. Typically it could be 60, even 90 or greater. And if you don't understand that before you do sign like the dotted line of a purchase agreement, you may get into what is known as a cash crunch. So if you are looking at businesses that have long-tailed uh, DSOs, just understand what that looks like from a timing perspective, because this is an easy way and a trap new buyers will fall into for these types of businesses.
Thank you, Patrick. So, so in this slide, we have a illustration here. So, the first, for example, let's say this is a newly started company. Uh, in the beginning, they purchase inventory, uh, and let us say they have a credit period of 20 days. And in the second image, they they pay their suppliers, and on, let's say, on day 30, they have sold their inventory to their customer, and after 30 days of sales, they are able to collect their uh, payment from their customers. So the first bar which you see over here, which says inventory period, so this is the period the inventory stays within the company. And the second one, payable period, what it means is this is the credit period that was extended by the supplier to the company. So at this point in time, payment to suppliers, this is when the cash went out of the business. So what this means is, so the buyer will have, the owner of the company will have to bring in additional cash or utilize their letter of credit. So at this point, the company has not generated any cash. They have borrowed money to pay their suppliers. And lastly, when they have received payment, so this bar represents days sales outstanding. So at this point in time, they collect from their customers and repay their letter of credit. So this cash conversion cycle period. So over here, what you'd want is the cash conversion cycle period to be lower. So if a company has a longer cash conversion cycle, uh, the difference between when they make the payment to suppliers and when they receive payment from the customers, what would happen is that their interest cost would be higher. Their interest cost would be higher for since they would be utilizing their letter of credit. And so in terms of valuation, uh, a company with longer cash conversion cycle cannot be valued in the same manner as a company which has lower cash conversion cycle, meaning the speed at which a company generate cash should also be uh, factored into when valuing a company, because the cash generated would the free cash flows available would be higher whenever the cash conversion cycle is lower. And any questions up till now?
Yeah, so I have one, and it might be one that people ask me about cash conversion. So when you're when you're looking at the cash conversion, and this might be jumping ahead to our example, like what is typical terms you've seen in industry, like for small businesses?
So so it depends on industry, right? So in terms of manufacturing, like if some company is manufacturing, it goes from 60 to 90 days. Um, so if it's a retail business, which does not have any customer payable period, most of the sales is in cash, right? So they tend to have around 10 to 20 days. And healthcare is a longer cycle, which has around 60 to 70 days. Um, so a company which caters to uh, other businesses, B2B businesses, tend to have around, let's say, 30 days to 50 days of cash conversion cycle. So whenever we're computing cash conversion cycle, what we want to see is this business similar to other businesses in the industry? Like whether the efficiency is better than its peers or worse than its peers. Because the standard multiple which you would be using to value this company cannot be applied if it is not in line with the industry cash conversion cycle.
Yeah, that makes sense. And last thing to add on this one, I would understand historical averages of like typical cash conversions. So what that means is if you just look up, conduct independent research, understand what are like general benchmarks of businesses in certain industries and like what do those cash conversions look like. And if you have that information before you review the data, you can understand if the prospective business is outside of those averages. You need to ask those questions about why are the averages either significantly less or significantly higher than historical averages. And it's important to ask this because they may come back with two reasons. One, the financial data, which is the Excel financial statements and balance sheets used to calculate the cash conversion cycle, they may be poor data. So if the company's not applying correct accounting principles, that could be a driver of why the DSO and DPO are off. And the second thing could be operational. So if they're operationally flawed and they don't have strong accounts receivable collection periods, maybe they had some turnover, which is leading to AR going significantly aged. You can understand, is this like a financial data quality issue or is this an operational issue? So those are two key pieces. Conduct independent research around historical industry averages and then arm yourself with the tools before you head into due diligence.
Yeah. Yeah. Thank you, Patrick. Uh, moving on to the next slide. So over here, we'll show you a practical demo of how we can compute the cash conversion cycle. Let me just quickly share my screen. Uh, is the Excel sheet visible? Okay, great. So over here, we have a basic template to compute cash conversion cycle. So here, we'll be computing it for 2023, 24, and 25. So basically, we would be taking balance sheet data as at December 23, December 24, and March 25. So whenever you receive data from the sellers, you'd want to compute this. Overall, what we have seen is a lot of the initial work just revolves around the income statement and does not include a lot of analysis on the balance sheet. However, looking at the balance sheet does help us understand how efficient is the company and how is it being run. So it does let us know what are the sources of funds and how it has been utilized. In terms of working capital, cash conversion cycle is very helpful. And so, so let me tell you how this has been computed. So first of all, since we are doing it for the entire year, 2023, 24, and for 2025 March, what we have done is we've taken the data from April 2024 to March 2025. So this also has 365 days. So since we are computing it on an average basis of 2000, on a yearly basis, 12-month basis, what we would have to do is we'll have to go to our income statement and take these respective data from income statement and balance sheet. From the income statement, the data that you would require would be the revenue and the cost of goods sold. So these would have to be respectively uh, linked to these cells. Like you would want to populate it this way, revenue and cost of goods sold. The next three items that would be required to compute cash conversion cycle would be accounts receivable balance, inventory balance, and accounts payable balance. So for this, we would have to go to the balance sheet of the company. And from this, what we would see is, so accounts receivable and inventory, we would get this data from the uh, current asset section. So meaning we would have take this balance from accounts receivable and inventory. So this data has been updated over here, and accounts payable data from the current liabilities section. So total accounts payable, whatever is the balance in the balance sheet, would have to be populated over here. So the first few lines, A to F, so these are the inputs for computing the cash conversion cycle. So if you remember from our first slide, so cash conversion cycle includes DSO, days sales outstanding, which relates to AR, days inventory outstanding, which relates to inventory, and days payable outstanding, DPO. So the first step, we will start with the accounts receivable balance. So first thing that you do is divide the revenue by the balance that is reported as at December for accounts receivable. So this would be a multiple. So here you have 12x, 4x, and 6x for each respective period. So what this means is theoretically accounts receivable balance gets fully collected 12 times in a year, 4 times in a year, 6 times in a year. And so since we are doing it for a full year basis, to compute days sales outstanding, we would divide the number of days by the turnover multiple, accounts receivable turnover. So 365 divided by 12x, you would see 31 days. Next, since it was 4x, 86 days, 365 days. Here, we've taken 365 days because the revenue that we are taking is also for 365 days. You could also do it for a shorter period. Suppose you'd want to compute it on a quarterly basis. In that case, these would be 90 days, 90 days, 90 days. And the revenue that you would take would be only for the relevant quarter. Suppose you're doing as at December on a quarterly basis, you take October, November, and December, 3 months of revenue, last 3 months of revenue, and the balance as at December. So this may change. However, this balance always remains constant. And so over here, this is a relatively easy metric to compute. However, the insights that can be gained from this analysis is very valuable. So now what we can see here is December 23, the day sales outstanding was 31 days, and December 24, it went up to 86 days. So when we inquired to target about this, what we noted was uh, what we noted was so uh, 2023 was their starting year, and since they were starting off, they were having lower value orders which were getting collected relatively earlier. So from 2024 onwards, they shifted to higher value orders, which can be also seen from the increase in revenue from 455,000 to 1.5 million. So since the order values were larger, because of that, their collection, they had to give additional credit period to their customers. So, so for that reason, they it took them more time to collect from the customers. So, had we just looked at the income statement, we would see only the revenue growth, and we would not be able to decipher how does this revenue convert into cash. So by computing these simple metrics, we can get to know a lot about the operations of the business. And additionally, uh, uh, now we'll talk about inventory inventory days. So again, similar to accounts receivable, what we would do is cost of goods sold would be divided by the inventory balance in the balance sheet. So, so one thing that I'd like to explain is, so accounts receivable is an output of revenue, and cost of goods sold is an output of inventory, and accounts receivable is also an output of cost of goods sold. So for that reason, when we compute the day sales outstanding debtor days, we use revenue and AR. And when we're dealing with uh, DPO and DIO, we use cost of goods sold number and the inventory and accounts payable balance. And here, what we have done is the cost of goods sold that is reported in the income statement, that has been divided by the inventory balance. And here what we've seen is it's 3x, 12x, 12x, meaning the inventory is ordered three times and 12 times. So over here in 2024, it's we can say that it's roughly ordered once a month. So one thing that can be seen here is the cost of goods sold was lower in 2023, since it was their starting year. So for that reason, the inventory did not turn as much as it has turned in 2024. Here you can see that there has been a significant growth in cost of goods sold, which is in line with the revenue. So as the revenue has gone up to sell more products, they have purchased more products, and roughly they have ordered it once a month. And so now to come at days inventory outstanding, the inventory days, what you would do is divide the 365 by the inventory turnover multiple. So for 365 divided by 3x, 108 days. So this is relatively a very long period to hold inventory. So if you see such numbers like why is a DIO number very high, then you would want to ask the sellers on what is the business reason behind this having such a high number. And as I mentioned earlier, since this was their starting year, uh, it took some time for the sales to pick up. For that reason, they had to hold inventory for a longer period. And also, if you see here, the inventory balances, right? 18 December 23, 89,000, December 24, 89,000, March 25, 102,000. So uh, although there has been a significant increase in sales, right? However, they are not buying more inventory. So what could be the reason? So like if you are selling more, definitely you would want to stock more inventory so that there's no inventory outage. So so in this case, what had happened was they did not have a bigger warehouse, right? So if there is a space constraint, meaning you can only store so much of inventory in your warehouse, then you'd have a higher inventory turnover. You'd have to order more times. Like if they double their warehouse capacity, then maybe they would only have to order 6 times a year. And uh, so things like these, this could tell you is like once I acquire the business and as I start to grow the revenue, maybe I will have to shift to a new facility with higher warehousing capacity. And also, one thing is like how much does it cost to order every time? What is the transportation cost? So those kind of decisions can also be taken in some cases if the transportation cost is significant.
One question to add on, I'm often asked about this calculation is what if the prospective business does not have inventory? And the answer is that happens frequently, and you would just simply ignore the inventory component of the calculation. So the cash conversion would effectively be the DSO, which is 14 and 15, and then the DPO, which is 20 and 21. So that's something that it seems silly, but I'm actually asked that quite a bit. So just wanted to call that out for you.
Yeah, thank you, Patrick. And also, now moving on to the payables turnover ratio. So over here, what we would be doing is we take the accounts payable balance in the from the balance sheet and cost of goods sold. So we would divide the cost of goods sold from accounts payable. So here, what we can see is so the accounts payable balance is turning 4 times in this particular period. So it becomes 0 4 times a year. This is a theoretical thing because the balances get paid on as per their credit period and new things keep coming in. However, theoretically, it turns 4 times in a particular given period. And uh, accordingly, when we divide 365 by 4x, we get payables days payable outstanding, which is 91 days for 2023, 92 days for 2024, and 73 days. So there is actually a decline. So over here, what would have happened is they said since they had lower sales, they would have had cash constraint in 2023. So there would have been some delays in payment of accounts payables balances. So for that reason, their DPO is higher in 2023. But if you look at 2025, it has decreased to 73 days. Here, what we can see is from 86 days to 64 days, they have improved their collection cycle from customers from 86 to 64 days in 2025. So accordingly, since they would have collected quicker from the customers, and uh, if you are collecting earlier, definitely you would be paying earlier to the vendors as well as per the credit period, and would not go beyond the credit period, or negotiate some terms, additional terms with the vendor. So finally, once we have computed the three metrics, days sales outstanding, days inventory outstanding, and days payable outstanding, we would compute the cash conversion cycle. So over here, if you look at this, so it would be 31 days of 31 days of receivable balance plus 108 days of inventory, subtracted by 91 days of payables. So we have arrived at 47 days for 2023, 26 days for 2024, and 22 days for 2025, the trailing 12 months 2025. So, so from this analysis, what we can see is in 2023, the inventory holding period was higher. They have purchased the inventory, but they were not able to sell it. So due to this particular reason, their cash conversion cycle was higher to 47 days. However, in 2024, what you can see is the inventory days have significantly improved from 108 days to 31 days. So what you can see here is this can also be seen with revenue. So since the revenue has increased, right, it means they were able to sell their products quicker from 108 days to so rather than holding it for 3 months, like if they purchase it at the beginning of the month, by the end of the month the product is sold out. So however, one thing which we can see here is although they have made sales, right, the revenue has increased by 1 million in 2024, but what this has done is the accounts receivable balance has gone up. So meaning it is taking them more time to collect from their customers. So whenever you see that the day sales outstanding has significantly increased, one thing you should look at is in your EBITDA, whatever sales is reported, right, the income statement, are maybe some of these sales are not collectible, right? In order to grow the sales, the company has been very aggressive and has made risky sales, meaning the customers credit profile was not checked properly, and some of these may not be collectible. And if something is not collectible, it should be a negative adjustment to the reported EBITDA. So let us say they've reported an EBITDA of 185,000 for 2024. And if I see maybe 50,000 is significantly significant old balance, which then I would ask the seller, is this collectible? So if it is aged, let's say, more than 90 days, then I would reduce it from EBITDA, and accordingly, whatever EBITDA I have, 185,000, so that would decrease to 135,000 because that 50,000 is not collectible. I would say it was done for growth of the company. However, it will not result in any cash. And accordingly, so here the payable days have remained constant. And if you look at 2025, so here in terms of inventory, it have from moving from 2024 to 25, the trend of 30 days has remained. However, they have been able to improve their collection cycle from 84 days to 64 days. And in terms of in terms of the supplier days, the vendor days. So now it is only taking them 73 days to pay their vendors, which is actually high compared to others. So if you see days payable outstanding of like 60 days, 70 days, then you would want to ask the seller, how is this being driven? Sometimes what may be happening is a lot of the purchases may be coming from a related company. So if the supplier is a related company, post transaction, when the new owner comes in, the same credit period may not be extended. So they may demand it quickly, meaning they may want payment within 45 days, 30 days. So that would significantly put an pressure on the cash conversion cycle. So as the cash conversion cycle goes up, the speed at which money goes out increases, meaning you'd have to rely on line of credit more, and your working capital requirement significantly goes up. And similarly, in terms of customers also, uh, if the days sales outstanding, the receivable days is significantly lower, let's say 20 days, 15 days, then you'd want to analyze some customers, like why is it lower? Is there a specific customer that because of which this is lower? Then if it is a top customer which is paying early, then that is a concentration risk that you would have to analyze. So like to compute this metrics is relatively simple, but just looking at this and looking at other supporting data can help you understand the business much better. While looking at the income statement and looking at the performance is good, uh, have looking at this metrics and seeing how the money is flowing, like how at when does the money come in, when does it go out, will help you understand operations of the business much better. Yeah. So, any questions on these? You can write your questions on the chat if there are any questions. So, uh,
So if you want a copy of the demo we just walked through, if you want to scan that QR code, we can automatically send you a copy. If you have any issues with getting the copy, feel free to reach out to Avi or I on LinkedIn or via email. But hopefully that demo sort of connected some dots of how to functionally calculate this in Excel. So I thought it was helpful.
yeah. So, I think we can go to the next one. So, why is cash conversion cycle important? So, as I mentioned earlier, a lot of the focus is on income statement and balance sheet is often ignored. Uh, However, EBITDA EBITDA is the performance in a particular year. EBITDA does not equal to the cash that would hit your bank statement in that particular year. So, if the cash conversion cycle is relatively higher, uh, the suppose if we make 100,000 or 500,000 of EBITDA, the free cash flow that is available to us for repaying the debt that we take on for acquiring the company would not be 500,000 uh, because because the 500,000 uh, so, would not convert to cash in that respective year, and so a major chunk of it may go to next year. Ultimately, the EBITDA will turn into cash, but it just takes a longer period of time. And and uh, during this period, you may would have to bring in additional cash or utilize your credit period, a credit facility. And like looking at the second point, CCC highlights hidden cash needs. So often, like once you compute the cash conversion cycle, if the cash conversion cycle is relatively high compared to the industry standard, then you know that like I will have to bring in more money. There's a certain valuation amount that I have to bring in, but later on, to run the business, I will have to bring in additional cash. And so the last one, liquidity and valuation. So I just touched upon the liquidity. So whenever the cash conversion cycle is higher, naturally the working capital in the balance sheet, the dollar amount goes up compared to a company which has a lower cash conversion cycle. So, mm, uh, so in terms of valuation, what you should also understand is uh, if I grow the revenue by let's say $1 million and revenue and the EBITDA accordingly grows up by 300,000, 200,000. So the ultimately it will take me more time to convert that into cash. So accordingly,
Yep.
when you discount this back, uh, the value of the company would be lower because uh, you are receiving money at a later date, and the interest cost on the letter of credit, the debt that you would accumulate to run the business would be higher. So for that reason, the free cash flow available for distribution as well as repayment of debt uh, would be lower. So for that reason, higher cash conversion cycle would decrease the valuation of a company. So prior to making an offer for buying a company, it is important to understand, uh, uh, will I incur more cost? Like, will I incur more borrowing cost because of this cash conversion cycle? So that is something which is often overlooked. So it is important to look at that as well. And uh, moving to the next slide. So, uh, so in this slide, we have a couple of red flags and best practices that we should adhere to. Uh, so in terms of red flags, the first one is window dressing before sales. So when we compute cash conversion cycle, we would want it to be steady throughout our review period, month on month. We would want it to be steady. If there is a seasonality, like in those respective months, the seasonality numbers should be also steady. However, if you see significant improvement in cash conversion cycle right before the sale, uh, so then you should inquire more into why has the cash conversion cycle improved. Is it because has the days inventory number gone down because you're not ordering any inventory? uh, is the uh, is the receivables going down because we're giving uh, discounts for early payments? And maybe it's because of maybe we're not paying suppliers, because of which our cash conversion cycle is decreasing. So uh, you'd want to ask your QFE provider to check for any window dressing if you see anything in your initial analysis. Uh, Moving to the next point, rising receivables, DSO. So in case the day sales outstanding number is increasing, what may have happened is, in order to increase the EBITDA prior to sales, right? Uh, Customers may have been given longer credit periods to purchase more. So if it is outside customary business practice, the regular business practice, uh, then it should accordingly be factored in your analysis as well. And next one would be inventory buildup. So if the days inventory outstanding is constantly increasing, what you should think about is, are there old unsaleable inventories in the balance sheet? Uh, Meaning, let us say in terms of uh, fashion, a clothing company. So by the time they reach winter, they should not have summer collection in their inventory. So if the inventory days are building up, it would mean that they've been buying, but they've been only able to sell 50% of what they purchase or 60% of what they purchase, and the inventory will keep on building. So accordingly, when you do an analysis, you would want to write down excess inventory which cannot be sold. And stretching of payables. If you see days payable outstanding, meaning the accounts payable, the vendor balances are rising, it would mean that the company constantly has a cash crunch. Maybe the debtors are paying them at a later point, or maybe they do not have adequate letter of credit facility. So for that reason, they are not able to pay their suppliers on time. So this should also be inquired into, why a supplier has not been paid like within its credit period. And lastly, is the change in control risk. Uh, this Let us say there is a significantly large customer, right? And post transaction, if they would want to negotiate terms with the new buyer or new owner, let's say they are paying the company in within 30 days, but when the new owner comes in, maybe they would want 45 days of credit period to keep doing the business. So this would accordingly have an impact on the cash conversion cycle. So if they decide to pay from in 45 days compared to 30 days, for that 15 days, you would have to borrow money to fund your operations. So this kind of items should also be considered. So uh, Coming to the best practices. So first one is request the balance sheet data early on. So initially, the focus is always on taking the monthly income statements and arriving at EBITDA, doing some owner add backs, and arriving at seller discretionary earnings. So, however, you should also factor in cash conversion cycle in your initial analysis as well, because uh, the EBITDA which you see in the income statement, will it convert into cash for in time for me to pay for the expenses? So that is also important. And next point is review aging schedule at various balance sheet dates. So by aging schedule, what I mean is, so let's say accounts receivable aging schedule. So there would be a certain number reported in the balance sheet. An aging schedule would have list of customers and their respective balances, and which would be divided into buckets such as not due, due less than 30 days, due for more 60 to 90 days, uh, due for more than 90 days. So accordingly, we can ask for receivable aging, accounts payable aging, and inventory balance aging. So whenever we analyze these aged balances, we should look at the uh, balances which are, let's say, more than 60 days, more than 90 days. If significant portion of these balances are uh, in more than 90 days or more than 60 days period, then there, then we should ask the seller about why these are due. Suppose a customer balance is aged more than 90 days, it could mean that it is aged for sorry, it is disputed by the customer, hence the customer is not paying, and it is a potential bad debt. And so accordingly, you would want to reduce that balance in the respective month where the sale was made, so that the EBITDA which you are paying for, right, does not include that sale which will not be collected for. And third one would be factor CCC into valuations. So by this, what we mean is, uh, when valuing a company, like looking at EBITDA and applying a multiple, is like seems to be the standard practice. But you'd also want to see uh, what would be uh, what would be the free cash flow based on the cash conversion cycle. So because uh, because what would happen is, if a company has a longer cash conversion cycle, suppose you pay 3x before acquiring the company, but after acquiring the company, you'd have to bring in more cash to run the business. Technically, you paid 4x and not 3x because you brought in more capital just to run the business. And lastly, engage engage quality of experts for deep review. So uh, in the initial phase, you'd be given limited data. Based on that, if you see some red flags in the cash conversion cycle, then you'd want your QFI provider to specifically focus on a particular point. Maybe if the DSO is high, or if the inventory days are high, then you'd want your team to focus on that and see if the quality of earnings, the adjusted EBITDA has to be brought down for these red flags. And lastly, we have an example in the next slide. Uh, so So over here, we have two similar companies which are doing 10 million in revenue. So the total expense is 9 million and EBITDA of 1 million. So when you divide this 9 million by 360 days, the daily expense is 25,000 per day. So the first company has a cash conversion cycle of 20 days. So for this company, when you multiply 25,000 by 20 days, the the cash requirement, right? The additional cash requirement is only 0.5 million, 500,000. But for company B, which has a cash conversion cycle of 50 days, the working capital requirement is significantly higher, which is 1.25 million. So, here, what would happen is, if we just apply a multiple to the EBITDA, for company A, we just have to bring in 500,000 as working capital. But for company B, we would have to bring over $1 million to run the business. So this is how cash conversion cycle can significantly impact your deal, uh, because we may end up buying a company that is profitable on paper, but to run day to day, we do not have cash. So that's why looking at cash conversion cycle in the initial phase is very important. Yeah. And uh, we can go to that. After the cash conversion cycle, we have given a general timeline on how to proceed with your deal. So once you the first step is getting a signed LOI. So as soon as you get your LOI signed, the first two things which you would do is start your financial due diligence, hire a QP service provider, and start looking for a lender to finance the deal. So this is something that would happen on the day one itself. And typically, you would want to close financial due diligence within 45 days. So once that is done, we can start. You would want to start with the tax due diligence process to see if there is any significant tax liability which the company may inherit in the new buyer may because the new buyer would need indemnity against any uh, tax penalties that may come uh, from the past. So tax due diligence will help you get shield against uh, any tax liability that is there, or uh, also structuring your deal in the most tax-friendly manner. And so this would this should this would start around day 30 and end around day 75. So and within 2 months, then you'd want to, considering if all things checks out, everything checks out, you'd want to start legal due diligence, which would also help you in preparing the purchase agreements. And if there are any findings in financial due diligence and tax due diligence, that should be factored into your final closing document, whether in the form of any representation, indemnity, or whatever the case may be. So that should be include all the findings of the diligence should be included in the final closing purchase agreement that would get finalized as part of the legal due diligence as well. And this is a general timeline for 90 days. So if you have a smaller deal, a smaller company, this may be 60 days as well. So you'd want to accordingly manage that. But however, in terms of starting, you'd want to start financial due diligence and the SBA process in the beginning, then tax, then legal, along with the final closing documents.